You are listening to the FEBIS podcast, and my name is Sylvia Amaral. To know more about FEBIS, visit our web at www.febis.org and follow us on LinkedIn, Facebook, and Twitter. Please subscribe to our podcast and stay tuned. Hello and welcome to this episode that I have the pleasure to share with Christian von Berg, economist for Northern Europe region and Belgium at COFAS. Thanks for being with us, Christian.
Yeah, thank you, Sylvia, and great to at least hear you and see you, and maybe you also in the future see again the great people from FEBIS.
Thank you. It will be a pleasure to count on your presence again. Well, Christian, we are here today to talk about a little bit different stuff, and I must say there are not many dull days in the life of an economist lately, are there?
Oh my God, yeah. I can completely confirm that. You think that there could be one spring in the last years where not a big thing is happening? Yeah, not happening again this year. So yes, we are again very, very busy. But hey, at least nobody has died because of it yet. So that's a good point.
Already an improvement, indeed. Well, but let's a little bit look at what we have on the table. 3 US banks fail. Credit Suisse taken over in extremis. And Deutsche Bank shares plummet. What is going on, Christiane? How did we get here?
Yeah, how much time do we have for this podcast?
As long as you want, as you know.
Okay. So, yeah, maybe we have to differentiate here a little bit because you mentioned three different aspects: the U.S. banks, Credit Suisse, and Deutsche Bank. And believe it or not, these are three different reasons. So let's start with the U.S., where everything started. In the U.S., we have some kind of a problem. We have here some medium-sized banks who are very much focused on startups, which is the case for the Silicon Valley Bank, but also the Signature Bank and the First Republic, which went, more or less bankrupt or had to be saved too. So we have these three banks here, and of course also others who are more or less in trouble. They have two different aspects here. First of all, they are very concentrated again on the fintechs or on startups. And the startups had a lot of short-term loans, and as the interest rates increased, more and more loans could not be paid back. So that's already a problem for a bank if the loans that you gave out will not be paid back with, of course, interest rates. That's the normal, the bread and butter business of every bank. Okay. This is the one side. The other side is, of course, that when you have deposits of a lot of companies, you can either take the money and give it out as a loan, or you can invest it by yourself. And these investments were done in very long-term papers. The problem is long-term papers had a specific interest rate, and now that the interest rates are increasing, the value of these papers decreased. Not so good, but still okay, as long as nobody's taking out your deposits. But if these startups have the problem that they have liquidity issues more and more and take away their deposits, then you have out of the sudden to sell your long-term investments with a lower value then. And that brings you by yourself into liquidity problems. And that's what happened with the SVB, the Silicon Valley Bank. I have to say here that normally there are quite strong bank regulations who prevent you from getting here into troubles because they said you need a specific equity share or other measures to prevent that you get in trouble if out of the sudden everybody's coming and taking out their deposits. This is not the case so much for these banks. Also a reason because the regulation was in place, but then this bank and others went to the administration of Donald Trump, said, hey, we want to make more business and decrease our regulation rules. And he said, yeah, sure, okay. And that's also an aspect here. So more or less a perfect storm for these banks, given also the fact that the risk management of these banks has apparently completely, slept over. I mean, guys, these interest rates increases is nothing that just came out of surprise. This is a development that we saw in the last year. So you could have done something right in advance when you saw it, but they didn't do anything, and that break their leg or their neck actually in this case. So that's the case of the U.S. banks, and also what is coming here into account is then the psychological effect of some kind of bank run, because we have in Europe a deposit insurance which is quite high. It depends a little bit from country to country, but for example, in Germany, it has several millions for companies. In the US, it's only 250,000 per company and per person. For a normal person, that's completely sufficient, but not for a big company when you have a lot of turnover. So this is also a thing that if you see that one is running to the bank, the next one is running, and then you get into a psychological bank run, which is of course always a very, very dramatic situation for a bank. Okay, so that's for the US. Coming now to Credit Suisse, different bank, different continent, different situation. Here we have the issue that the Credit Suisse was in trouble now for, not only months, it is now years. They had a lot of scandals. They did money laundering for the Bulgarian mafia. I mean, okay, also a business model if you want. But their problems were a lot in the management area. So they produced a lot of negative news, and that resulted already in Q4 2022 in very strong withdrawals from the deposit. Still everything okay, given the fact that they have a quite high equity share, or had above 14% equity share, so still fine. But what then happens was that the SVB happened, so everybody gets nervous, and then there was investment bank conference where the main investor of the SVB from Saudi Arabia was asked, hey, just in case if there are troubles, can you put in more liquidity? And from a regulatory reason, from the Saudi Arabian law, he cannot do that. He had already almost 10%. So you could have answered in the way, well, we really would like, but we have some problems here regarding regulatory. But no, what did this guy said? No, of course not. We will not do that. Yeah, not very wise when you have a financial market who is already very nervous. Of course, nobody paid attention to the fact that he is, from regulatory reasons, not allowed to do that. Everybody just heard, no, of course not. So this went into the direction that there were even more deposit withdrawals. The equity shares, not only the equity, but the shares at the stock exchange, they made like a free fall, and that's why they had to be taken over. Okay, so now we have 3 cases in the US, 1 case in Switzerland, and then you can feel, of course, that everybody is completely hyperly nervous. And then there is the case of the Deutsche Bank. And in the case of the Deutsche Bank, it is a little bit different again, because the Deutsche Bank does not have the problems with deposit withdrawals, also not from equity shares. So everybody was thinking, what's going on there? And we cannot see any fundamental reason. So from the balance sheet, everything is okay. But they had a restructuring program in the last years. They also had some not so good years in the past. And what we expect is that this was really an attack of investors, of hedge funds, who bet against the Deutsche Bank and who had short positions and hoped to make here a big profit in betting against the Deutsche Bank, and that seems the most reasonable explanation for the equity share plump in on Friday, because when you're looking at the fundamentals, everything is fine. But of course, right now in this tense situation, financial market participants are not saying, okay, let's wait, let's take a tea and think about it and then we react. No, it's the one on the right is running, one on the left is running, so let's run, because if you are not acting, then you are too late. And that's always a little bit the tricky situation with financial markets. Okay, and I think that's the whole story.
Well, thank you, and very useful to understand what is the background of each of those situations. Indeed, it is not all the same. But nevertheless, despite of the different backgrounds, I mean, are we talking here about a real banking crisis? Was this something expected? You already explained a little bit that it should have been, at least should have had some preparation somehow. But did it really catch us all by surprise?
Yeah, I mean, some part of this could have been anticipated and some part not. No, so that's something that we could keep in mind. So when you're looking at the U.S. with the Fed reaction to the high inflation, this is something the Fed has never increased so fast and so steep the interest rates before in the last 40 years. So I think that is maybe a little bit of a surprise, but I think at the latest at the mid of last year, you could have, as a good risk manager, thought about, okay, what is happening if they are increasing even faster, and changed your investment profile. I think that's something that you could have done, and therefore I say that yes, it could have been anticipated that some banks have problems, or companies. And I think that's not a big surprise. That's just pure macroeconomics, that if over a decade everybody was used to very high liquidity and extreme low interest rates, and if this is changing, then there are always people who lose and who are winning with this new situation. Savers are winning, and all the ones who have loans, especially if they are flexible, are the losers, for sure. So that's something that you could anticipate. But what you can less anticipate is the psychological effect behind everything. Because, I mean, the thing that the Credit Suisse now had these problems is something where you say, yes, there are fundamentals who were against it, but the main step who brought them into the big crisis was psychological speaking. It was this investor, and it was financial markets who made a big reaction to that. I do not think that this would have been the case if there were not the bankruptcy of SVB right in the week before. And the same, of course, with Deutsche Bank. Deutsche Bank, this is really purely psychological, that somebody or some group is using this very high nervousness, the nervous situation in financial markets, to try to bet against the Deutsche Bank without fundamentals being bad. So is it a real banking crisis? It depends. If everybody reacts calm, then it could be that this is the end, or that maybe some other smaller banks in the US get bankrupt, but that's it. But if the panic is taking over, then we see such things as Deutsche Bank. And of course, every bank, even the best bank in the world, if they take off all or out all with the deposits, then of course this bank gets bankrupt, even the best one. So it is a question of psychologically or psychology right now. If everybody stays calm, then it could be it. And if this nervousness gets around and spreads and financial markets go down, then we have a problem. But what we have also to say, everybody needs a bank more or less to work. So where should you go then? I do not think that this is an all-over effect, but but that the banks who were in trouble before could be more victim of these attacks than others. But some have to survive because otherwise we do not have a bank to work with.
Right. So it's case to say, don't touch your money, keep calm.
Yeah, that would be helpful, at least for now. And it depends also where you are. In the US already, there were some new measures to insure your deposits even higher. And as I said, in Europe, the deposit insurance is definitely higher, so no reason to react right now.
All right. Well, what does the Federal Reserve and the European Central Bank increase of interest rates mean? Was it a good decision?
Yeah, the two central banks have right now quite a big problem because they are in charge, first of all, on monetary policy. And yes, they have two different targets. So in the US, the Fed has two targets: first, price stability, and then also full employment. In Europe, it is only price stability. Employment is not a target, but also they are bank supervisors. So not very easy right now in their position. The Fed, I think, is quite clear that the interest rates were one reason why this crisis started. But what should the Fed do? That's the problem. I mean, look at the inflation. It is still very high. In the US, it's around 6%. So far higher than the 2% target. And if you are not reacting to it, then financial markets could anticipate, so they gave up. So we should increase our inflation expectations for the future. And this means that inflation remains quite high. If you are thinking about, for example, if you are a landlord or landlady and think about a rent, and you anticipate quite a high inflation, you will probably already in the first contract implement or hikes of your rent so that you get the money and the value of the money, of course, the purchasing power of it. But this would mean that the one who has to pay it has higher inflation practically. So this is a self-fulfilling prophecy that comes up. That's why I would say that the Federal Reserve and the ECB did well, the ECB especially, because here we have to say that we do not see really that much bank risk because the regulation around financial markets and banks is quite stronger, also still intact. And what would have the central banks done if the ECB would have said, no, I do not do that? So what you have to keep in mind is that this 50 basis points that they decided last week was already in their communication before. So already in February, they said, hey, in March, we will increase our interest rates by 50 basis points. If they would have not done that, it would have been a sign to financial markets, I think there is something behind it. Banking sector doesn't seem so healthy at all. Even the ECB is now not trusting its regulation anymore. And then financial markets would have anticipated, I do not know what's going on, but just to be sure, be safe and take your deposits. So I think that in keeping on with their business, it is like the British say, keep calm and carry on. The best way to keep also calm the financial market.
I see, I understand. Well, basically, you almost answered the next question I had, which was with this scenario, where does inflation stand? But I don't know if you want to complete a little bit more around it.
Yeah, I think that's something important behind the inflation that is needed to understand what's going on, because you could say, well, inflation is not at 2%, but it is falling. So the inflation rate right now in several countries is decreasing, and you could say, yeah, we are on the right way, and we know that that monetary policy has quite a long time lag between the decision and the reaction really in the, we call it real economy. So this takes some time. So we could stop now and wait until the reaction is fully in place. The problem behind that argumentation is that the inflation rate, as the one that we are looking at, is the yearly development or the yearly percentage change between price level today and the year before. if you remember how the time was last year, 27th of March, when we are recording this, it was really that energy prices hiked extremely because of the start of the war in Ukraine. So prices were extremely high due to energy prices. Of course, this price increase is not there anymore, but it doesn't mean that our prices right now are not increasing, or that they are decreasing. They are still increasing on quite a high level. This time not so much from energy, but a lot from food prices or other goods that become really expensive. So there is still this price pressure coming up, an unusually high one, but nothing compared to last year. And this is why, mathematically speaking, right now the inflation rate will fall, even if we have on a monthly comparison quite strong price pressure. And that could fool really some people who say, yeah, everything is fine. No, it's not fine. It's just not as bad as last year. And this is why the ECB and also the Fed are still reacting to the situation.
Could this be the beginning of an economic crisis? What immediate and midterm effects can we expect?
Yeah, I hope that this question is not aging bad, because if I say now, yeah, everything is fine, and then everything goes bust, you will probably quote me a year later and say, yeah, do you remember this time when you said, hey, everything is fine? Yeah, so I try to answer that a little bit more diplomatically speaking. If we are looking at the fundamentals, I sound like a central banker. I would say no, we are not in an economic crisis. I mean, what you have to keep in mind is this saying, you can't make an omelette without breaking eggs. So when you have this high inflation and you're fighting against this, there are always losers. And there are always, if you are growing, everybody remembers from the childhood, this is painful. This is not nice. Of course, people have problems, and we see it. Inflation is high, consumption goes down, growth is not the way that it was in the past. But I would not say that this is a crisis. This is an adaptation process, who is not very nice for many, but for others it is quite nice. I mean, if you look at the savers, I am sitting here in Germany. We have a lot of older people in Germany who are still like old-fashioned savers. For the first time in a very long time, they get interest rates again. So yes, you have also people who are profiting from it. It becomes a crisis if the situation turns into into the panic mode. Because if we have panic, that's always bad for financial markets, and we know from the last time in 2008-9 that a crisis can start in financial markets and then get over and in contagion the so-called real economy, because you do not have investment value, and that people who are not the old school savers but invested on stock exchanges lose their money and have less savings from that side. So this is maybe how I would answer it. For now, it's an adaptation process, but it can become a crisis if panic's starting to go around. Yeah.
Back to the same sentence, better to keep calm. Carry on.
Yeah. The British knew what is important.
Exactly. Well, thank you so much for your valuable insights about the current banking turmoil, and especially to help us understand what is going on really, and not just get the false picture from the news sometimes that puts it all in the same bag. It's important to understand the backgrounds, the different backgrounds, and that helps us not to panic and keep calm, definitely. So let's see where it ends up. Christiane, thank you very much, and hope to see you soon sometime for, I hope, not such a turmoil.
Yeah, I hope so too. Thank you very much, Sylvia, for having me.
We would love to hear your feedback and thoughts for future episodes. You have been listening to the FEBIS podcast. If you like the content, please subscribe. Thank you for listening.